Perfect, we're in.
Hey, superb. So, Trevor Cutmore and Simon,
Mishevich.
there you go. Say that if you like. Okay, listen, it's great to be with Simon. Simon's come to my house today and we've been having a nice lunch together. Enjoyed that lunch?
Very much. The sea bus was perfect.
Yeah, good. So, I used to be a chef for many years. Listen, it's great to have Simon because obviously he's a property tax accountant, but a real specialist and top of his field. He's someone who I've known for a long time, trust implicitly, and I refer people to him as often as I can. We've been having a chat, and there's a few things I want to actually clarify because I get asked a lot of things by a lot of people when I go around talking and actually training people. One of those things is when people want to, should they set up a company? If they do set up a company, they think they can do it online, £15, and they haven't got a clue about these sick codes.
And I think there is an element of DIY
Yes.
in this. That everyone likes to try and do something totally DIY. And if you look at my properties, guys, I have a lot of properties myself. Trevor has properties. It sounds like he does a good job of doing these properties. I'm not so good. And if you'll know this, because when you go to see my properties, they are shambolic whenever I touch them. I've got walls that are being plastered by me, and you could tell because they've got these kind of straight lines down the side.
Oh, nice.
Yeah, and when I'm doing the touching up of the paintwork on the gloss, it goes onto the wall and vice versa.
Yeah.
So it just never looks good. Why am I telling you all of this? Is only because DIY is never really good unless you're an expert.
Exactly.
So I always get a tradesperson, and I think the thing I would say about DIY also complies with any professional work that you can get done.
Yeah.
Cheap is good, but then when it's the cost of getting it wrong.
Yes.
So right now you might do something that's quite cheap to begin with, but how much can it cost you for getting it wrong down the line? And that's where I would always say speak to a solicitor or an accountant. You can speak to either, and they will help you set up the company in the right way by understanding the basics of circumstances. What are you trying to do? What is this company set up to do? What's your long-term goals? And indeed, who do you want part of this business, and who are the decision makers? Who do you want to be passing assets over a period of time? And it takes a long time to think about that. When you're sitting in front of the DIY computer setting my company up, you don't get asked these pertinent questions. No. And therefore, it can be easy to kind of get it wrong by kind of just going ahead, setting up a company, and then not realising actually how much damage you've done.
So if somebody goes online, they set up and they look at the SIC code and they say, okay, I've got a couple of properties, I'm going to take the rent and bring that in. And they think, okay, I've got the right SIC code for that, that's fine.
Yeah.
But let's say 6-9 months down the road, all of a sudden they get an opportunity to build a house. And they go and they think, well, I've got a company, it's a property company, I'm just going to go and build a house. So they go and do everything. And then when they come to their tax return, let's say it's in the second year, what's going to happen?
Well, funny enough, the SIC code isn't so much of a problem for the accountants or the tax returns. The government aren't too concerned about whether you got a SIC code wrong. Right. I've never, in my experience, come across something, unless you're trying to claim something called entrepreneur's relief, so you're flipping a company down, but then it's actually an investment business. Where you can come a problem, and we had this several times this year or last year, 2018, is where you set up a trade company, and that's because you're a consultant of some sort. We've got medical locums that will set up the limited company for that. And what they will try and do is then buy property inside that same company, which is never a good thing to do anyway. But the problem is that when the mortgage companies come along, they'll say, what's your SIC code?
Right.
So you've gone all the way through to try and buy this property, and the banks have said, but your SIC code is wrong, and now you've got it wrong, we do not want to lend to this company.
Right.
So you've now got to have the hassle of going to create another company. And that goes back to my DIY points, because people will set up a company, use the wrong SIC code because they think it's the right one, and then come along with the banks more than a tax person, and it can scupper your deal, or at least delay it.
All right. Now, obviously, we haven't actually defined what a SIC code is. It's not about vomit, is it? Can you just explain to the layman, what is it, and why do we have to have this associated with our companies?
A SIC code is just typically a few digits code that tells company's house what your activity is. So you will have, even within the world of property, you've got the managing of letting businesses, managing your own company, properties, and therefore that's two SIC codes. So it's just an identifier
Perfect.
to Companies House, and that's it.
Brilliant, but it's so important getting it right, and that's
Yeah,
why.
so true.
Look, we both say, go to the professionals, go to your accountant, have a chat, and I always get my accountant to set those companies up for me. I don't want to know. I'm a property investor, and coming back to your DIY, what I do now is I go in, I see the property, I negotiate a price. And quite often I won't see that property again, and it's all done by professionals. I won't touch
Very
it.
true. Very true.
So there's no. I used to do tiling and stuff, but I won't touch it.
No.
No.
I think the last time I did something was when I was trying to plaster the roof or the ceiling, and it went straight in my eye, and that was it. I was done for days. And
Yeah, you can see.
never
My
nice.
hands are very soft now. I don't have any hard blisters on them anymore.
If people touch my hands and they say, you can tell you can work in the office, right? So that's very true.
Okay, look, moving on then.
Yeah.
I'd like to talk about limited companies.
Sure.
Okay, so again, a lot of people say, should I have a company? Should I buy or do an activity such as rent to service accommodation? Should I do it in my own name? So there's two different things there.
Yeah.
Can you just explain a little bit when should be and why not, and what's the advantage?
Let's take a step back, actually. What is a limited company designed to do?
Perfect.
I think the one thing I would always say that a limited company is designed to be a tax vehicle.
Yeah.
It's an ability to de-risk your business as well.
Yeah.
So we'll touch on both points. Let's talk about the risk because that's out of the way then. The risk side of things is if something is being developed, so a property you're developing inside a limited company, you've got a roof tile, it hits a passenger by, and it unfortunately kills them off. What will happen is that they will sue you, quite rightly, or the family will be, and the assets within that entity, that special purpose vehicle, that limited company, will go to the people that are suing you, basically. Now, if you don't have a limited company and that particular property development is in your home, your name, everything that you have, every asset that you own could be at risk.
Yes.
So all of a sudden you're going by now and they will still sue you, but it's you as an individual.
Yeah.
And as a result of that, that will then, all your personal assets will go to the family. That's obviously go through his grievance. So from a risk point of view, a limited company is very, very good for that side of things.
Yes.
But let's get back to tax, because that's why most people set up limited companies. And the corporation tax rate right now is 19%. And it will fall down to 17% in due course. Well, that's hopeful.
Yes.
Now, that's a good thing, because if you compare that to a basic rate taxpayer, which is 20%.
20%, yeah.
Right? So you've already got a 3% saving eventually. Now, that's a great thing, and that's why people set up a limited company. But we often get around to clients coming on board and they're saying, well, I've already got a limited company set up. Can you look after it for me? And it's amazing how many we close down. So out of 10 clients, we will close down 3 clients' limited companies totally.
Right.
And the reason for that is because we say, well, what is the purpose of this company to do? And it's, I think it's an angle of looking at the short term as well as the long term.
Yeah.
And saying, okay, let's take a broad brush approach of the next 5 years. Is this vehicle going to be supportive? Now, giving you an example here, if you're a high rate taxpayer, the natural tendency would be to say, you definitely need a limited company because you're a high rate taxpayer.
Yes.
Look, you're paying 40% tax in your own name, and the company's only going to be paying 17%. You're crazy not to do this. But my view is, well, a client that I was talking to today was, he's looking to retire in just 2 years' time.
Yeah.
So as a result of that, his income goes from £200,000 down to 16,000 because of his pension.
Fine.
And he wants to top that up with an investment. I was saying, well, you'd be nuts to have a limited company because your limited company is going to get a mortgage, which is 2% more than if you get this mortgage in your own name. And you've got this other issue of now we've got administration of that company. You've got the accountants to look after it. You know, that they want their pennies, right?
I know they do.
They
do.
Unbelievable. Unbelievable. So you've got this scenario whereby you have all these people taking money because you've got this limited company. But all the time, this person may have been better off by having a lower interest of buy-to-let mortgage in his own name,
Yeah.
and then just having the tax at 20%. His wife, interestingly enough, didn't own or didn't earn anything. She was a housewife, so she had £11,000 which she could earn for personal allowance, no tax at all,
Yeah.
and therefore assign portion of the property. So instead of having the property 50-50 as a couple, you could have reassigned some of that beneficiary entitlement to 99% to his wife. She gets all the income, and a lot of it will be tax free. And him, even now, at earning £200,000 at 1%, you're not going to be paying too much tax anyway.
Perfect. What I want to do, because look, this is absolute dynamite. I want you just to explain that just again, because some people are going to miss that.
Yeah.
And look, I understand exactly what you say. And when they buy the property in their own name, can they do it just in his name? Can they do it in both names? What would be the best way?
I think, again, it's back to the point of your current situation and where you're going to go.
Yeah.
The one thing I'm going to caveat all of this, by the way, is if you do a change of ownership between husband and wife, and it has to be husband and wife, let's forget about partners that aren't married. If you are husband and wife or civil partners, then you can transfer assets between spouses and there won't be any capital gains tax.
Perfect.
There could be an SDLT liability if you've not got a joint mortgage.
STLG, I know, but
Yeah, so stamp duty land tax, right?
Okay.
So stamp duty land tax.
that's why I'm here,
Yeah.
just to pull it in.
Yes, it's good that you are here.
Yeah.
Because it would be pretty lonely for me right now. But so the stamp duty land tax is a tax that you get charged for buying property, whether it's a residential investment property or indeed your own home. Let's be honest. So the SDLT could be a charge. It could be a slip up if you haven't again gone to professional advisors to say, what do I need to watch out for when I'm splitting the assets from one person to another? But let's go back to that example because we've got someone who's earning £200,000 and his wife is earning zilch. She's looking after the home and the children. And what I was suggesting to them was, well, have 99% in her name because she's not earning anything. So you may as well use that personal allowance. And then 1% goes to him. So from a tax position in the immediate term, it's good. Long term, we know that in 2-3 years' time, he's going to change his position. So he's now not going to be working. He's indeed going to be just settling down with his pension money as well as this property income. And what he can then do is then do another deed of trust that says, instead of 99-1, I'm going to change that back to 50-50.
Perfect.
So you can do deed of trust as many times. You can change the order of those.
And that was my question. How do you do? So you've got the mortgage.
Yeah.
But how do you do that split? And that is a deed of trust.
Correct.
That is registered on the title deed?
You can do.
But
yeah.
it's what the tax accountant would give to the HMRC.
Yeah, exactly. And it's really making sure that you've got this listed details to do a deed of trust. We do deed of trust as well.
Yes.
We've been working with solicitors to draw that up for clients. And a big thing for me is if you've got properties, and this is something to watch out for. Here's a watch out for you guys. A watch out is where you've got a property and it's currently owned 50-50.
Yeah.
You want to reassign that to a different percentage. So let's say you want to assign 99% to one person and just 1% to the other. You have to do a deed of trust, which is a legal document.
Yes.
But you also have to submit a Form 17, which is a beneficial interest form, to HMRC, accompanying the deed of trust.
Perfect.
Now, it is.
This is what we want. This is really good stuff, guys. This is what we want.
Do you know what's happening right now?
No.
We're getting a lot of clients coming to us and saying, well, we've done the deed of trust. Well, on my tax return, we're going to now split that from 50-50 with 99-1 to one or the other partner. And we say, well, great, did you register it with HMRC? And they look at me blank or they talk to us and you can tell that there's a silence on the other line of the phone. And you say, okay, it sounds as though your solicitor's done you a deed of trust, but did you think about doing the Form 17, which has got to be with HMRC, with together with the deed of trust and the Form 17 within 60 days of that deed of trust. Right. So if you haven't done that, your deed of trust is actually void.
Oh.
So imagine that.
Wow.
Right? And we've had solicitors who said, well, it's not our fault. That's a tax thing, and really they should have known. But how many of you listening right now know that you've got to do this?
Yeah.
is fraught with issues, and solicitors aren't being proactive enough for me. In fact, I was on Facebook the other day. I commented on this situation, and a solicitor was straight at me saying, "Oh, it's terrible that you should be so negative towards another profession." And I said, "Don't worry, I'm negative towards other accountants as well." So, but I think we do need to be
No,
careful.
but that is really, really good. I mean, that is top professional advice, which, I'm learning as well, and that is really good. So I know that's going to give great value to a lot of people, especially, some people will be thinking, oh my goodness. So if it is void, if they hurry up, do another deed of trust,
Yep.
could they backdate it 60 days or 59 days and submit the form?
Yeah, I tend to say do it 40 days. I'd say
Yeah.
it's 40 days because it's got to get to HMRC.
Perfect.
And let's be fair, when it gets to HMRC, they've got to do the administration
Okay,
process.
okay.
So that can take 2 weeks.
Yeah.
And therefore, I would always say just allow yourself 20 days to do that.
Perfect. Great advice. But okay, we talked over lunch a little bit, and obviously I'm in a position where my assets are growing and just continuing to do that, and I have 4 children, and so obviously I'm looking towards the future, and you through this thing which I've never heard before, really interested, and you talked about freezer shares,
Yeah.
and this is really about me future pacing my assets in the companies to benefit my children after a certain level. So can you just explain a little bit in layman's terms so we can all understand?
Well, I'm going to go a bit beyond that, if that's
Perfect.
okay with you.
Please.
Because I think there is always a missed opportunity. People look at limited companies as being helpful because it provides you with tax efficiencies, but they don't really look at all the other benefits that you can get. So if you've got a pen and paper, it's probably worth you writing a few key notes for this. Your company, Trevor's wearing glasses, right? And if he was wearing those for VDU work, his limited company can pay for those. And indeed the eye test that you go with it. If you're like myself and Trevor's just slightly over 40, we can tell that. But just a little bit. But I'm over 40 as well, I'm a lot.
Are you?
Yes, I am.
Oh, well done.
Oh, so sweet.
You're
so
looking
sweet.
good, man. You're looking good.
But the thing is, I can go to a private GP. I want to make sure that this body is well tuned. He always tells me that I'm overweight, which is fine. I can always do something about that. But it's nice to know that my health is in good tip-top condition.
Yeah.
I'm committed to my work, committed to my clients, and my family, which is really important. And therefore, I've got to be really healthy.
Yes.
My company can pay for that.
Perfect.
Right, and it can also give me some gift vouchers. So we all like to celebrate. My limited company can give me throwaway £50 voucher now and again, and I can go to John Lewis, Waitrose, and spend that from the company as long as it's a voucher, and away we go. So those are some kind of little trails of golden nuggets.
Explain the voucher.
A voucher, yeah. So a voucher is you get these, right? How many years do you go by, and you get your card. Yeah. And you know full well that the person who's bought you a voucher really haven't thought well enough about what you want for Christmas.
Yeah.
So you get these vouchers that are non-cash redeemable. So that's what it is really, is that your company would buy that cash non-redeemable voucher.
Right,
so
okay.
at John Lewis at £50.
Yeah.
And you slip that into your wallet, and then you take it to John Lewis and you spend it.
Perfect. So how many times a year can I do that?
So as a director, you can do that. You can spread it over a period of a year, and it's up to £300.
Perfect.
Yeah.
I didn't know that. That is brilliant.
Yeah.
I'll make a note of that. That's fine. I'm out tomorrow.
So tomorrow Trevor's straight out there to Waitrose or John Lewis.
Please
on the company.
don't tell my wife.
No.
All right.
But the problem is, Trevor, is this is public.
Oh yes.
She's likely to hear through the grapevine that this is all going off behind her back.
I'll tell her. I will tell her.
So those are little crumbs, but that's the thing about limited companies. There's so many things that you can look at. But let's get to the serious thing here. I believe that when you've got children, we should all be looking to kind of making sure that they're set up for the future, because we don't know what this country is going to be like. We're not going to talk about Brexit. That's another subject. But we don't know the state of this country, how it's going to be. So we always kind of think about, well, let's set them up in business. Let's make sure we have a property portfolio that can pay for their life going forwards, and they can get involved. Now, the key thing is, with all of this, is we forget about IHT. And let's be fair, we always think about income tax because that's the here and the now. We always think about capital gains tax because when we're selling a property, that's the here and the now. But we never really think about IHT.
Inheritance tax.
Yeah, I was just about to say, right? So I knew this question was going to go. I was hoping I'd slide it in without really being noticed. But IHT is a death tax. So once you, as an individual, you get over your threshold, over that threshold, you are taxed at 40% tax, which is not a kind of a small tax fraction at all. It's a significant amount.
That's right.
But you can create something in your company which is called a freezer share. And a freezer share basically says, right, I've got this company and I personally want all the net asset value up to the IHT band.
Yeah.
It might be different for some people, so I'm not going to say what those are. But you will need to speak to your accountants and tax advisors. So at this point, your company is valued. Once it gets to that value, the excess over that value for IHT purposes automatically goes to your children.
Yeah.
So therefore, you've kind of safeguarded yourself around IHT, and it's something that's been around for decades.
Yep.
Doesn't get talked about.
Doesn't.
And the reason, to be fair though, Trevor, is people don't really talk about IHT.
Right.
The accountants don't talk about IHT. The families don't really want to talk about IHT. No one wants to say, well, next month I might not be here and we might need to do something. And therefore, it just gets left alone.
It's an interesting one. You know, one of the most powerful talks I saw on TED Talks was a guy talking about a 200-year plan. He was an Indian gentleman, I think a student or something. And he was talking about things to set up that would affect his family in over 200 years. If we look at people like Cadbury's and Rowntree's, which aren't clever names for chocolate and sweets, they were family brands. And they actually wanted their workers to be more productive, so they built houses and so they have better living conditions. But that has turned out to be massive for them because they've looked ahead of time how to continue on their family traditions, their family name, family profits.
Yeah.
So these freezer shares is something which I'm definitely looking into and going to start to implement. How easy? So just explain. I can go now look at my company. Obviously, let's say one of the companies, my wife and myself, we can create non-value shares.
Correct.
In that company and attribute those to my children.
Yes, I mean, you can set these shares up as a penny. Now, the first thing that will go through people's heads will be, can 123.co.uk do this for me for £12.99? I've got to be so honest, no, they cannot, because you're going to have different classes of shares. Typically, when you set up a company through 123, whatever they are, they will set you up with something called ordinary shares.
Yes.
That's it. That's all we know.
Yeah.
But when you set up this kind of structure, what you might have is an AB share, which is husband and wife share, and then you could have C, D, E, all the way to Z, depending on how many children you have in your family.
I've got four. I'm not that busy.
There we go. So 4 children, they can have penny shares. And doesn't really have much more value than that, and I'll come on to the reason why later on. But those shares will sit there. You take all the dividends and wages out of that company as you will, as you normally do, and there's no real impact. There's a couple of things I want to bring to everyone's attention about this. I have seen whereby people set up a limited company and they've instantly given their children 10% of the business.
I've seen this, yeah.
And the problem with this is, one, they will say, well, I want to pass my 5-year-old some dividends out of my limited company and therefore utilise their personal allowance. But in reality, that's what's happening for that 5-year-old. They're not getting that money, are they, for pocket money? All that's doing is that mum and dad are taking that money, putting it into their bank account, and that's tax-free money. And the unfortunate thing about this scenario is that any payments to a minor, so under 18 or someone slightly over but in full-time education, any income that they receive from their parents will be taxed as the parent.
Yeah.
So you might have innocently thought, well, I'll set this company up with 10% shares for my child. £10,000 goes to my child because it's below the personal allowance. No tax, perfect, happy days. That's paid for our holiday, right? And unfortunately, HMRC will say, well, actually, that's not true. They are a minor, and that income now needs retrospectively needs to be put onto your tax bill, which is like a bit of a shocker to everyone.
Absolutely. Unless obviously there was a football manager that managed to use his dog But anyway,
Yeah.
we won't go down that
Yeah.
road. But that.
Well, I tell you what, because otherwise we're getting to comedians.
Yeah, no,
and
we
that's
don't-
no laughing matter.
No, very good. I like that one.
So, but the other side to it, and the final piece of this jigsaw really, is the 10%. If you've got a limited company and you're dependent on the banks giving you a mortgage, and you've got 10% with the children, your banks will say, "I want your 5-year-old to go through a credit check."
Yeah.
So I would never advise it. As soon as you give your child any more than 1% share of your business, we're already seeing this, that the banks will say, we want you to reverse that out and then give them zero value. And that's why the freezer shares really work, because they're a penny share. They're not a significant value at all. And the banks are going to be fine with that because they know what is there, but they're not going to be really well.
Will you have to supply their identity and their addresses when you're going for mortgages with those freezer shares, purely because they're named in the company? Is that something we might have to do?
If there was significant value, then 10% or more, or even 5% we're seeing now, 5% or more, that would be the question. But I've got to ask you, Trevor, I have shares in Microsoft, and this is a client who wants to ask me this question. When Microsoft go for a building, and I doubt they need a mortgage, guys, but let's imagine that they were pretty poor. I think they're number one value company now in the world, again, over Apple. But if they went for a building, got a mortgage, would they ask me as a shareholder to go on the application? Right. No. So it depends on how much of a share valuation I have in that organisation. If you've got 5 or 10%, you could be in danger of this. If you've got less than 1% value going to your children, I don't think you have to worry.
No. How is Bill Gates now?
Well, I had a cup of tea with him the other day, and he's absolutely fine. Yeah.
Nice. Moving on, CGT.
Yeah.
And HRT. Not HRT.
IHD.
Good,
you now.
Good. No, CGT.
Yep.
Talk a little bit about that and how. So let's suppose you build one house, and that's been your project, and you don't do anything else in that year, but then you actually build. The next year, you might build 2 houses. So obviously, how does it work when we're going to pay CGT, and how do we mitigate paying CGT?
Yeah. Well, I think that the real thing I would say is that capital gains tax, CGT.
Yes.
I've explained. So this time I got you. So the capital gains tax is the tax that you will pay on selling an investment that you've held and you had a return from. The misnomer, interestingly enough, is whereby people have bought an asset, flipped it, and then thought it was capital gains tax. Well, in actual fact, we've got a message up on here.
Ah, that's all right.
Is that all right?
Been stopped automatically. Why has that just come up? Movie recording. Yours is frozen. What's happened with that?
Yeah.